Have you ever wondered why the price of a phone made in Asia or a car from Europe changes over time? The answer often lies in something called an exchange rate. This is simply the price of one country's money in terms of another's. Think of it like a price tag on a currency. When this price tag changes, it affects the cost of almost everything you buy from another country. It can make your vacation abroad cheaper or more expensive. It can also change how much a company earns when it sells products overseas. This silent force shapes our global economy every single day. This hidden price mechanism is constantly moving, influenced by governments, banks, big investors. For example, if the US dollar becomes stronger, you can buy more of another currency, like the Japanese yen, with each dollar. The United States has a complex relationship with its currency, the dollar. Officially, the U.S. Treasury has long maintained a strong dollar policy. American consumers can buy more foreign goods and services for less money. American businesses can buy more foreign goods and services for less money. This helps keep inflation under control by making imports cheaper. For the average American, this can translate to lower prices. Clothing made in Vietnam, electronics assembled in China. It also makes traveling abroad more affordable. American tourists, American investors. However, the main tool the U.S. uses to influence the dollar's value is interest rates, set by the Federal Reserve. When the Fed raises interest rates to fight inflation, it makes holding U.S. dollars more attractive to global investors. Investors buy dollars to invest in U.S. bonds. This increased demand for the dollar pushes its value up. October 10, 2025, the Fed has maintained relatively high interest rates. Japan's primary economic goal for decades has been to overcome deflation and to stimulate growth, largely through exports. A weaker yen is a powerful tool for achieving this. When the yen's value falls, Japanese products become cheaper for international customers. Toyota cars, Sony cameras, Nintendo game consoles. This boosts sales and drives profits for Japan's largest corporations. In theory, that encourages them to invest more at home and raise wages. For an export-reliant economy, a competitive exchange rate is a lifeline. To keep the yen weak, the Bank of Japan has pursued ultra-low, even negative interest rates. Unlike the Fed, which has been raising rates, the BOJ has kept its rates near zero. This makes holding yen unattractive versus higher returns in dollar assets. The yield differential has driven massive flows out of yen into dollars, pushing the yen to levels not seen in over 30 years. The policy is a double-edged sword. A weaker yen makes vital imports, oil, gas, food, drastically more expensive. Fuel, electricity, and groceries have all risen, squeezing households without strong wage growth. China's approach to its currency, the yuan, also called the renminbi, is fundamentally different. The primary goal is not a free-floating currency, but one carefully managed for stability and to support the government's economic objectives. Beijing wants to prevent sharp fluctuations that could disrupt trade, trigger capital flight, or create instability. A stable yuan helps exporters and gives foreign investors predictability. This control is a cornerstone of the state-led model, managed growth over market freedom. The main tools are not Fed-style rates, it's capital controls and a daily fixing rate. Each morning, the PBOC sets a midpoint for USD CNY and allows trading within a narrow band, typically 2% either way. Capital controls restrict outflows and help prevent a sudden currency crash. But with property stress, weak demand, and slowing growth, easing rates risks yuan weakness. So the PBOC leans on fixes and reserves, directing banks to support the yuan and project stability. When we place the strategies of the United States, Japan, and China side by side, their contrasting priorities become clear. The U.S., issuer of the primary reserve currency, prioritizes fighting domestic inflation through high interest rates, accepting a strong dollar. Japan, desperate for export-led growth and to escape deflation, keeps rates ultra-low, sending the yen lower. China occupies the middle ground, managing the yuan to seek stability above all. As of late 2025, the Fed funds rate is 5.25%, the BOJ policy rate about 0.1%, and China's one-year loan prime rate near 3.45%. This divergence is the engine of today's FX dynamics, why the dollar is strong and the yen is weak. Toolkits differ. The Fed's blunt rate tool, Japan's near-zero rates plus interventions, over 62 beers in 2022. China's daily fix, capital controls, and state bank operations. Risks mirror goals. The U.S. risks hollowing out manufacturing. Japan risks impoverishing consumers and disorderly moves. China risks a forced devaluation and capital flight. The ongoing currency battle creates clear winners and losers. Winners: American consumers and tourists. A strong dollar boosts their purchasing power. Imports and travel are cheaper. Import-heavy corporations enjoy lower costs, better margins, and sometimes pass on lower prices, helping tame inflation. Losers: consumers in weakening currency countries, especially Japan, facing higher fuel, food, and material costs. U.S. manufacturers and exporters also struggle as their goods get pricier abroad. A stronger dollar raises the real burden of dollar debts in emerging markets, risking financial distress and instability. China plays a long game. Keeping the yuan stable enhances its appeal as a regional trade currency despite yen competition. In this web, gains for one group often come at another's expense. Currency moves feel zero-sum in an interconnected system. In summary, policy divergence defines today's currency landscape. The U.S. leans on high rates and a strong dollar, good for consumers and inflation control, tough on exporters. Japan's ultra-low rates boost big exporters but hit households via costly imports. China meticulously manages the yuan, seeking stability amid internal and external pressures. The Fed's actions ripple worldwide. So long as the U.S.-Japan rate gap stays wide, pressures persist. Ultimately, the delicate balance between the dollar, the yen, and the yuan holds a key to global stability. And no policy is an island.